With that, I think it's time to launch into a really fascinating subject, venture capital. Of course, for many, many startups, most startups, funding is a really important question because you have to convince a set of people that your idea is worth risking significant amounts of money to fund. Investors might be there to help you out, certainly in family and friends. That can be a meaningful factor in why they would invest. But for the most part, investors invest to get a return on that investment. So they're looking for success, and ultimately they're looking for an exit. They're looking for some event down the road such that they will be able to sell their shares and get cash back out of it. And that usually means that they're looking for an eventual public offering or an eventual acquisition. Conceivably, there are investors who want a future cash flow. That is, they would like it if you reached a point as a company where you threw off dividends from your great profits, and they would get their return on those dividends. But that's extraordinarily rare. I don't think anybody really funds tech startups in a hope that they remain private, but generate cash flows. Sometimes the original founders are that way, and maybe family and friends, but venture funding is really a central consideration here. Let me double check and make sure that we're recording. This is supposed to be automatic, but oops.
I think we're recording, Chris.
Recording
Okay.
is on, but AI summarization's not.
That's all right. So, in a sense, the big idea here is, how do you make this trade-off? You give up ownership, you give up a bit of control, you certainly give up a fraction of the returns in exchange for being able to have the resources that allow you to move quickly, to fit into a market window. And how do you do that? And how do you still keep it your idea, your direction? And this will lead to a really important question about what your motives are as time goes on. Are you most interested in a return yourself, or are you most interested in being in control? I certainly faced this at a critical time at Tensilica, where I recognized that we might be more successful if we had a traditional business guy as CEO, and that I needed to step into a more technical role, giving up control, but increasing the likelihood that we would be successful. I think ultimately making that trade-off was important, and I think I justified it to myself in that I had, from the beginning, a real obligation to the other founders and employees to make it as successful as possible. It was not an easy road, and often I doubted whether it was the right move, either for me or for the company, to be honest. But it ultimately did succeed, and it was a case where this trade-off between ownership and acceleration is not just a question of raising venture capital, but anything where you make trade-offs for the success of the idea over personal motives. And we'll come back around to this question as the time goes on. So let's talk a little bit about the funding climate and the funding journey. And it's important to recognize that the risks, especially the externally measurable risks associated with a startup, don't evolve in very continuous ways. There are milestones, there are key accomplishments, both material and symbolic, that really define what stage you're in and what the next big thing is that you have to do. And a well-defined funding strategy takes that into account. And it really is, well, what money do I need to get to the next stage where the risks are significantly reduced, or the risks have changed to the next class. The first risk might be, can I build it? And the second risk is, will anybody buy it? And the third risk is, will enough people buy it in order to create this virtuous cycle of revenue and market adoption and reputation? And the fourth risk might be, does the company run so smoothly that it can be a player in a public market where the deep scrutiny and the short timescales of financial performance have changed a lot relative to a private company? So there are these distinct phases that a company goes through, and funding is really about not just filling up the tank, getting some more money so that you can continue on for the next 6 months, 12 months, 18 months, but takes you to someplace really worthwhile where the issues have shifted. So I looked at Crunchbase a few months ago, maybe beginning of the summer, to get some ideas about, well, what is the current climate? And the investment climate is always changing. It's a function of what's going on in the public markets. It's a function of the economy globally and in North America. It's a function of the attitudes towards technology in the investment community. And that will do a lot changing how much money investors put into venture capital and how venture capital chooses to allocate that money across different segments, across early stage versus late stage, across different specific themes that they may develop. So we can look at this and say, well, if you look at how much money has been raised by big venture capital, you can see that there is quite a bit of money. And in fact, it peaked in 2022 with lots of cash flowing into these. And by and large, the venture capital firms have lots of money under management. And one of their challenges is, how do they get returns at scale when they are entrusted with so much cash? So it's typically not a challenge now to say, is there money in the market that is potentially chasing venture investments? It's more a question of which investments and at which stage. If we look at the levels of venture capital investment globally, these have been increasing significantly in recent quarters, but you'll see that the real increase is in later stage. They're putting more money into bigger, more developed deals, and the early stage investment is kind of flattish. That's obviously not great news for those of you who are in the early stages of developing something, but this too is somewhat cyclical. But in the age of AI, where AI is taking a significant fraction of investment dollars, it does mean that there is a lot of attention on the mega plays. Who's investing in Anthropic and who's investing in OpenAI, that puts a little bit of a shadow on other kinds of AI investments. And the AI enthusiasm has certainly put a bit of a shadow on other segments, unless they have a very strong AI element to them. People building new generations of GPU may be okay, though the barrier to entry for the next NVIDIA is pretty high. We can also see it in this same kind of information about early stage investment. This is the same dollar numbers as down below here, but you also see that the number of deals is going down, sort of in proportion. So early stage deals are not getting bigger, they're getting slightly rarer. And the overall number of deals is on a steady decline. So more dollars going into fewer companies. It's a piece of the reality, but it does mean that if you look here in fairly recent quarters, you're talking about venture deals which are only in the range of a couple of thousand per quarter. That's actually, a fairly good sized number, but that's spread across lots of different domains, and it's spread across um, uh, entrepreneurs at all different levels of sophistication. It does tend to mean that if you're going to get a classic venture capital deal, you need to have a pretty good package of idea, demonstrated product market fit, a strong team with experience and technical insights and track record, and you need to fit with the venture organization's theory. And I think every major venture capital firm comes up with an investment thesis, an idea of what is important right now. And they double down in that area, and they do a lot of work to understand what are the dynamics in that specific area so that they can not only be experts in choosing what they believe to be the winners, they actually can be materially helpful to their investment portfolio because they really have taken a close look at the competition, at the underlying technology trends, at many of the factors that will affect that area where they choose to focus. It's important to understand what investors are investing in and figure out how to adapt the facts of your situation to the story that you tell. To a large extent, investors want to invest in people who are smart, innovative, experienced, versatile, forward-thinking. They want to invest in markets that are big and fast-growing because they want big, fast-growing companies to come out of it. They like disruptive products or technologies, ones that are not competing head-to-head on an even playing field with existing business models and products and franchises, and which can create large new businesses at this point of disruption in the market. So the simple version of the story answers these questions. It talks about the people, the market, the product, of course. And it's working to answer this question in the investor's mind. Can this group grow rapidly in this market with this product idea, or with some product idea which is closely adjacent to this? I think early stage investors do understand that you are still in the midst of an experiment. And even if you have established some initial minimum viable product, MVP, even if you have established that you've got 5 customers, 10 customers who are responding well to your initial product idea, they understand that this will continue to evolve. They just don't want to be funding blank sheet of paper, rethinking from scratch about the market or the product. They want to see that you're learning and leveraging that and evolving. The more savvy version of the story also answers the question, why now? Why is this the right time for this market and this product idea? And it has to do with the notion that there are certain points in time when a market, a product area is ripe for disruption, and they want to understand if this is the magic moment for that product or technology. Is the technology ready? Is it something where you can actually say, yes, this reaches the point where it can be produced in volume to solve this problem, and where, from a product perspective, the use case, that pains and gains picture, is changing in a significant way, such that somebody who's coming along and saying, I am going to relieve your pain in a new way because I understand your pain in a new way, because your pain has changed recently, that this particular idea can come in and be disruptive. And this notion of timing is an important one. It's both self-reflective. Am I really ready? Is this technology really ripe? And it's about being able to read the market and understand, especially through the eyes of the user, how is their world changing. So you need money for your business. You probably have to pay people so that they can eat and pay for housing. You have to buy computers. You have to buy computing resources. You have to pay for coffee in the coffee machine and space potentially for people to sit. There are lots of things that are going to eat up money. And so sources of capital is important. And you can think about the various stages and the various kinds of organizations. In the very early stages, you may look to your own savings. You may run up big balances on your credit card. You may look to family. In the case of Tensilica, in an abstract sense, I put $1 million into the seed funding of it. But in reality, that was $500K from me and $500K from my dad. And eventually he distributed those shares to my brothers and sisters. So all of my family were shareholders. And these were pretty benign shareholders. They didn't make angry demands for liquidity or have too many strong ideas about what we should invest in next. On the other hand, taking money from family can also be very awkward if there's misaligned expectations. And I certainly advise you not to hype the ease of return to your own family, because it will cause problems. Because they may say after 5 years, I'm ready for my $200,000 back. And you say, I'm sorry, it's all tied up. And they say, well, when can I get it? And you say, I don't know yet. And that may cause some conflict. Seed money can come from early stage venture capital companies who like being at that very early stage where the idea is only slightly proven. Sometimes you can find it in incubators. Y Combinator is most famous in that area, but they put in a small amount of money and they really provide resources, in some cases analogous to what I'm doing with this boot camp, to help people move up the learning curve more quickly. There are various kinds of government research programs. David Chen, who's in this class, has done a really good job of leveraging U.S. government funding, particularly on the defense side, as a way to fund the company. And it's worth a conversation with him about how he has worked that system. Crowdsourcing is a possibility, particularly for more modest size investments or where there's something which is kind of publicly tangible that comes out of it. Angels are a very well-established category. These are high net worth individuals who really like the idea of investing. And they range from very sophisticated to not very sophisticated at all. And you have to, again, make sure that they understand the timelines for the typical venture investment. Then increasingly, you get into corporate and institutional VCs, classic VC firms, but most of the big tech companies make investments as well. They are less often the lead investor, but they like the idea of having a position, having a window into a segment and into a specific company. There are also what I guess is generally called super angels, people who make large enough investments that they actually can contribute as a piece of a Series A. These people would not be the leads of a Series A kind of investment, but they can materially flesh out a Series A kind of round. And then there are later stage deals where you're now looking at growth money, not money to establish the idea. This most classically comes from corporate and institutional VCs, especially existing investors. But you can also look at significant investments from customers, particularly if you find a way such that the investment from one customer doesn't scare away other customers. And you might find that there are very large private equity funds and the like that spread a lot of money around. The psychology and the goals for late stage investors is generally different. They're not as risk tolerant. They are judging more on what's the momentum of the business, who are the pre-existing investors, and they're looking for a lower risk. And because they're late stage, they may be lower return. So those are the major sources of capital as I see it. One mechanism has really become very prominent in the last 15 years or so, which is the SAFE. This is a vehicle for pre-seed and often seed investing where you don't want or need to spend a lot of time working out all of the details of a investment contract, a sale of shares. If you look at the amount of documentation that goes into a classically priced funding round, it's enormous. It's hundreds of pages of documents potentially. It's a lot of fees going to lawyers to work out all the deals. And it's almost always about what happens at the end, at the point of liquidity, or the point of liquidation of the company, or the point at which there is some really bad and improbable thing that's going to happen. And the idea of the SAFE is to kick all of those issues down the road, including the question of price, of what is this business valued at, by saying, here's some money, the investor gives some money and gets a right to participate in the next round, the next priced round of funding, and they will ultimately get shares in the company after the next round of funding. And we'll talk some more about this, but it's a very straightforward way of doing early stage fundraising. There is a notion of venture debt. This is loans from banks that is used to fund the development and expansion of the business that typically has pretty modest collateral. And it is something that, for example, Silicon Valley Bank has really done a lot of. And they typically are making loans on the back of companies that are getting funding from big name venture capital or corporate. So that, in a sense, the security of the loan is the fact that the other investors are likely to stand by this company through at least a moderate amount of upheaval. And that gives them some reassurance. There may be some commitment of intellectual property rights or other things associated with it, but usually it's debt that just carries an obligation to repay without much recourse for the lender. It's not secured in any significant way. That's pretty rare. It's usually done in small amounts. I've used it multiple times very successfully because it adds just a little bit more liquidity to the balance sheet that gives you a little bit more freedom of movement. And that's very helpful. But you're not going to fund your whole company on venture debt. It's just going to be a little bit of a boost. So you've got this range of different sources of capital. And it's really important to understand, at least in a general sort of way, what is the mix of strategic and financial goals? What's the level of experience that the investor has in the target markets and even in startup funding? I mean, particularly when you talk about angels and family and friends kinds of things. What is their ability to help guide and aid the company in other ways? Classic VCs have enormous resources and willingness and eagerness to provide that influence. Your Uncle Joe may not know a lot about what you need to do next on your deep tech startup. Different investors have different depth of pockets. A classic VC and often corporate VCs do have deep resources, and there is an expectation that they will be at least willing and perhaps eager to continue to support, potentially increase their share in future rounds. And for the more sophisticated investors, they have their own theories about what's going on in the market. What are the mega themes? And they may have a focus on particular themes that they think are winners.